Welcome back, traders. And in today's video, we have got a crucial aspect of trading that is going to be fundamental to your success. And the concept that we're going to learn today is multiple time frame analysis. And up to this point in this course, this is going to be the most vital thing that you've learned. And it's a cornerstone for technical analysts all over the world. And we will be talking about time frames constantly when we're trading. And as an analyst, you will be changing time frames on your charts all the time, trying to zoom in and out of price and trying to just dissect it from all different angles. Multiple time frame analysis is simply the process of looking at the same pair, but looking at it on different time frames. And a time frame is defined as the time it takes for one candle on the chart to form. On this chart here, you can see we're on the monthly time frame. So each candle takes 1 month to form. And within each monthly candle, you'll get 4 weekly candles. Within each weekly candle, you'll get 5 daily candles because there's 5 days in a trading week. And within each daily candle, you'll have 6 different 4-hour candles. Within each 4-hour, you'll have 4 1-hour candles, so on and so forth. So everything is just subdivided down. And the reason why we use this is because we can get clear on a high time frame where price is heading longer term, and then we can enter on a lower time frame to get a better position in price. And it's important to note that time frames are important because the higher the time frame, the more reliable you have, the more reliable data you have. So what that means is that if we look at the monthly time frame, we can see the entire chart going back to 1994. So this is all the data you can ever have on the Euro USD, on Euro dollar. There's no more information than this to analyze. This is the entire book. Okay? So when you bump down time frames, it's like you're reading smaller sections of a book. So the monthly is like reading all 7 Harry Potter books. You've got everything right here. Everything you could ever need to know is right here. And when you go down to the daily, we'll say that's like reading a couple books out of the Harry Potter series. Now you can pretty much get a good idea for what's going on, and you can definitely use this as a standalone to trade on the daily. And it's just as you bump it down, you go down to the 4-hour. That's like one book in the series. You go down to the 1-hour. That's like a chapter. The 15-minute is like a paragraph. All the way down to the 1 minute where it's like one word in the book. Each time frame that you go down, you get less and less and less information. If you remember from the monthly, we can see everything. From the 4-hour, it only takes us back to October. And yeah, we can zoom out, but we start to lose some of this. If you want to get the whole chart on the 4-hour, you can't do it. The maximum I can go back to zoomed out like this is back to September of 2018. So again, the higher the time frame, the more reliable the data is. And the less likely your trading strategy will become nullified. So if it's on a higher time frame, you've got a better possibility of your move actually playing out as opposed to the 1 minute or the 5 minute. And let me break that down a little bit more for you. That's important to know because when it comes to multiple time frame analysis, you'll notice that we're in a downtrend on the monthly. But on different time frames, we're going to be in different trends. We might be in a downtrend on the monthly, but an uptrend on the daily. Or a uptrend on the daily, but we're in a downtrend on maybe the 1-hour or the 15-minute time frame. So this is crucial to know, and I'll show you a perfect example why that is. So just to mark this up quickly, we're in a downtrend on the monthly. And this is how we're going to analyze charts. We're going to start at the monthly and work our way down to our entry time frame. Start at the monthly, and then we're going to go down to the daily. So on the monthly time frame, we've got a lot of room to go until we hit that trend line. So when we go down to the daily time frame, you can see that we're starting an uptrend. Okay, so downtrend on the monthly. We're beginning an uptrend on the daily because we've got the higher high, higher low, higher high, expecting a higher low, and we want this to continue to form. We go to the 4 hour, we're still in an uptrend. We go to the 1 hour, we're still in an uptrend. We go down to the 15 minutes, we're no longer in an uptrend. On the 15 minutes, we're trending down. Okay? So you can see clearly that we're in an uptrend on the higher time frames, but on a lower time frame, we're trending down. And why this is important is because, let me redraw this a little bit here. Just make it a little bit more accurate. This is important because what's going to happen is a lot of traders get stuck on one time frame. And what that does is it causes you to trade in the wrong direction. So let's say you're following this downtrend. Okay, so you want it to come here and then go down for the sell and then come back again and then go down for the sell and then come back again and go down for the sell. If you trade like this only on one time frame, you don't have enough information. Because on the 15 minute, that might just be like a few sentences from a book. And what can you really tell from that? You can't really tell the whole story. So we need more information. This is not reliable enough on the lower time frame. So we need to look at the monthly. Okay? And we need to look at the weekly and see what's going on. Okay? So we know that there's a lot of pressure to the downside. We can look at the daily. Okay? But we're in a daily uptrend right here. So if you look at what price has done previously when it's gotten close to this trend line, that it hasn't sold, it's gone up. So if you're trading on the 15-minute trend line or on the 15-minute time frame and you take a sell right here, you're selling directly into an uptrend. You're selling at the bottom. And the last thing you want to do, obviously you don't want to sell low. You want to sell high. So analyzing each and every different time frame is going to give you a much clearer picture on what's happening. And it'll help you avoid doing things like selling right there. Selling directly into an uptrend. But again, I'll tell you, people will just get on to the 15-minute time frame or the 1-minute time frame and they'll just start going to town. You know, they'll just start trading. They'll try to find a trend and start trading it, only to have the trend reverse. And what happens when you do that is you're just late to the party. You can't anticipate what's going to happen next. Like for us, since we know that that trend line is there, right here, that trend line that we made on the 4 hour, since we know that's there, when price gets to here, we're not looking to sell. Sure, if it breaks down and it retests, yeah, then we can look to sell. But when it gets here, we need to either look for it to go up and reverse or come back down. So that's the basis of your multiple time frame analysis. And just to just to recap, we look at the higher time frame to build the story and to predict the next chapter in the story, instead of sticking to lower time frames where you can absolutely get torched in situations like this and situations like this, trying to buy in these areas, trying to buy in this area, because you weren't aware of the pattern on a higher time frame. So to conclude, we just need to look at the higher time frames, build the story, get a good idea of what's coming next, and that's when we drop down and use the lower time frames to get better entry prices. So the higher the time frame, the more likely your analysis will play out. And when we talked about the different types of traders, we discussed this briefly. We talked about the time frame that they trade on, how swing traders will be more likely to trade on the daily and the 4-hour. Position traders are going to trade on the weekly and the monthly. Scalpers are going to be all the way down on the 1 minute, probably getting burned and blowing their accounts. Intraday traders are going to be on the 4-hour and 1-hour mostly. Everything comes down to multiple time frame analysis and knowing where the market is going longer term in a bigger picture. Get a bigger sense of what's happening. And again, each trader should get comfortable with time frames that fit his or her own personality. And we'll teach you, how to look at different time frames to make you better and give you more educated trading decisions. Because as you go down in time frames, patterns become more clear. And just to give that example, this is the monthly. And right here, it's not really a discernible pattern. There's a lot of things here that you can't really get a ton of info from that. It would be really hard to take a sell right here off of the monthly alone because you can't really see what pattern is forming. But when you break it down, you can clearly see the channel that it's forming. You see how much easier that looks like it is to trade? Instead of having that little tiny candle, you can see all the price action here. You can see the patterns forming. You can see things like this. You can see the channels within the channels. You can see all the different patterns. And that's why we use multiple time frame analysis. Get the big picture and then break it down so that we can enter more efficiently. Okay? So higher time frames have authority over lower time frames. Consult the higher time frames, get an idea of the bigger picture, and use lower time frames to enter with better precision. I know I've said that a few times. Trust me, I probably sound like a broken record on this one, but it is that important. It is so, so important that you understand this. So if anyone has any questions over this, please let me know, because if you don't understand this, then it's going to be really hard to follow along with the weekly outlooks and the daily outlooks and everything like that. You won't have a good idea of what's happening. So one more time, higher time frames are more reliable than lower time frames. Look at the higher time frames first, then go down to the lower time frames to find patterns and enter with more precision. All right. I definitely suggest on this one to go back and just kind of look at some things. One thing I wanted to show you, actually, I'm going to use a little bit of a different pair on this, just because that pair hasn't been moving over the past couple of years. It's been kind of slowly going down. But what I mean by like the division of the candles, so we're on the weekly here. I'm sorry, we're on the monthly. I'm just going to highlight this real quick. I want to show you that on the weekly, that's roughly 4 candles. 1, 2, 3, 4. And within each one weekly candle, there's going to be about 5 daily candles. 1, 2, 3, 4, 5. Yeah, it overlaps a little bit, but I can't draw it as precise as I want to. And on each daily candle, when you go down to the 4 hour, it breaks it down even more. Breaks it down even more. You can start to see the patterns forming, the impulse and the correction. You can start to see it. Again, even greater detail here. You can start to see where the actual trend is. So on the 15-minute, you can see the trend. But on the monthly, it just looks like this candle. So there's more precision and detail on the lower time frames. But there's more reliability on the higher time frames.